Okay. What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be taking a look at Shake Shack stock because they recently reported earnings and the stock is getting destroyed right now. The stock is down 29% today. So, you look at the past year, this stock was over $140 about a year ago, and now it's been cut in half to under 70. Look at the last 5 years, now it's getting closer and closer to its 5 year low. And so this stock has just been a disaster if you have been a long-term shareholder of this company. This is now a 2.9, yeah, or 2.7, I think it's a $2.7 billion company now. And so we're going to see, is this stock a buy? Because they do have good cheeseburgers. And so we have to see, is this actually a good investment opportunity? So Shake Shack reported earnings of first quarter sales of $366 million, which is up 14% year over year. If we compare that to the last couple of years of revenue growth, we can see the last 5 years they've averaged 22%. And so it looks like growth is slowing just a bit. Revenue growth the next 2 years is expected to be close to 15%. So it looks like that's a pretty consistent number for them. Now, the same Shack sales. This is an important number because I just did a video on Portillo's and they are struggling with this. Their same store sales are not up. Same Shack sales are up 4.5%. So that's a good sign. And I always think it's interesting that these companies can grow same store sales even though they've been there for, let's say, a decade or so. It's been there for a while. And people already know about Shake Shack. People know if they like it or not. And so to me, it's interesting that they can still find new customers. This company was founded in 2014, so they are 12 years old. And I think most people are familiar with Shake Shack. Shake Shack said it has opened 17 new company operated shacks and five new licensed shacks. So let's see, for 2026, they're expecting revenue of about 1.7 billion, which does that align? Yeah, that aligns with that. And last year for 2025, they did 1.4. So we'd be moving from 1.4 to about 1.7 and a restaurant level margin of 23%, which is pretty good, even though right now their margins are really bad. For the second quarter, we're looking at revenues of a little bit over 400 million. Okay. Now here's another thing I highlighted. Shake Shack is appointing Michelle Hook as Chief Financial Officer, effective next week. She joins from Portillo's. And like I just said, I just made a video on Portillo's stock. They are struggling big time. Portillo's is another local fast food chain, delicious food, lots of options, lots of people, lots of customers, but the margins are struggling and they're not growing. Now, she served as CFO since 2020 at Portillo's. And that's not a good sign because if you look at Portillo's, like I said, if you look at their business and their stock, it's been tragic the last 5 years. Before Portillo's, she did spend more than 17 years at Domino's, which Domino's is a success story, and that's where she spent most of her time at. So that's a positive. And that doesn't mean you got to take this with a grain of salt, kind of. But it is very interesting. I mean, this is probably a big accomplishment. But the past 5 years as CFO as Portillo's doesn't mean it's all her fault. But I mean, is that a good sign though? If Portillo's has been struggling, no, it's not really a good sign. But again, not the end of the world. Then we come over here, take a look at their sales. We're looking, like I said, 1.4, so a $2.7 billion company. I don't know why this stock is always traded at such a premium. It's trading at 67 times trailing 12 months earnings. If we look at, let's see where the last couple of years, this PE has bounced around a forward PE between 50 and 100. That's where on the forward basis. Look at the trailing basis. It's been 500, 600. So it's just, I don't know why I guess people were excited when the stock first went IPO, which was what, 2015. It's been a while now. So this stock has just not been a good performer. And it's really because of that valuation. The valuation doesn't make any sense. I don't know what are you paying for? They're growing at 15, 16% a year in sales. They are opening new locations, and I think they do have people do like the food. But I mean, net income has not improved much, really. It's gotten a little bit better, but it's very volatile. Same thing with free cash flow. They'll probably get it back up to this 60 million mark, I would hope. Same thing with net income. I would hope they get it back up to 50 million or so. The debt now is a lot. The debt now is over double what they have in cash. And luckily, the shares outstanding, they're actually buying back shares. But when you're not a profitable company, a lot of times they have to buy back or not buy back, they have to issue more shares, and that hurts the shareholder. Then we can look at the last couple of years return on capital. It's only 4%. Again, profit margins are bad. They're under just, break even or a couple percent. And then we get to the valuation. So let's see. Price to earnings. The stock is traded as high as 2,000 times earnings, which is very interesting, right? And it's been trading in the 80s, in the 90s, in the hundreds. It's like I don't know why would you pay for that? They're not growing that much. Free cash flow yield is terrible. You're getting a terrible deal. You're getting less than 1%. Price to sales. Luckily, it's come down a lot now. So it's down to what, 1.8, which that's fine. That's healthy. So price to sales is really not the problem. It's really earnings and free cash flow. That seems to be the issue here. And yeah, so the sales growth is not bad. It's just there's nothing wrong with sales and price to sales. It's just the earnings and the cash flow. They need to get those numbers up. And so let's say they're expected to do what are they going to do? For EPS, they're supposed to do 1.3 again this year, then 1.7. So, at this point, I would say, let's say for 1.7, if you're paying like even like 30 times is like, that's not really cheap. But it's fair. So, I would probably value the stock at like $50. That's roughly where I would, that's roughly where it's valued at, in my opinion. Then we come over here. So, restaurant level margins are sitting at 21%. While this is an improvement over last year, higher corporate spending on marketing and technology led to a small net loss this quarter. Normally, Shake Shack trades at a very high multiple because they are pricing in unit growth potential. Currently, the P is around a 70. Explaining why it's so sensitive to earnings. Analysts are targeting adjusted EPS of $1.50. Blah 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 blah. Their long-term target is 1,500 locations, and so this is what this looks like, right? So if it's 1,500 locations and they're expected to do what, get it close to 900 in 3 years from now, next year they want to hit about half of that. Let's say at the end of let's say 2027, even 2028. So we could say in about 2 years from now, they should be half of that, which means, and they're growing at 15%, which means EPS will be around $2.30, $2.40, let's say. So let's say $2.40. Again, I would pay I would say it's maybe valued at 30 times earnings. Then it's a $72 stock, like a year, like at the end of 2027, basically. That's how I'm valuing this. And okay, so let's say they grow a lot. When are they going to get to 1,500 locations? Well, it's probably going to be 2033 or something like that. So let's say it takes, what, 7 years to get there. And it should be roughly, yeah, probably at least $5 EPS, I would say. I would say at least $5. And look at even what they have for expected PE ratios. It's expected to get cut in half just over this 2 to 3 year period. But let's say they're going to do, so if they're going to be doing per store, so they're saying about, what is that? Each dollar of EPS for about 280 stores, right? So if we go 1,500 divided by 280 stores, that's about $5.35. Okay, so let's say 7 years from now they reach that goal of 1,500 locations. EPS will probably be 5.30 or maybe even 6 because the margins typically improve with scale. So let's just call it 6. It'll probably be close to 6. And if you're looking at $6 EPS times what? 25 times earnings, something maybe 20, let's say 25. They're obviously not going to have that same growth. They'll be lucky to have 15% growth in 7 years from now. So you're looking at I would say $150 stock 7 years from now. You see, so I wouldn't buy the stock unless it was like $30. That's like where I would buy this, $35, something like that. That's where I see this as a good buy. The next 2 years is expected to be the efficiency phase as the Project Catalyst. Now, this is very interesting. AI-driven kitchens and new loyalty program matures. Labor costs should stabilize, allowing EPS to grow faster than revenue. All right. Again, we've been hearing a lot about Chipotle and Wendy's and these companies utilizing AI and robots for automation in the kitchen. We have yet to, I know there's a little bit of experimenting going on, but not at a mass scale or any significance. So we have yet to see what that is really going to look like in the next couple of years, but it's very interesting to see. By 2029, the company is projected to approach a mature, fast casual status where growth slows slightly, but the massive footprint drives significant free cash flow. Right. And then now this is interesting too. As of this year's panel, Shake Shack consistently ranks as number one or two for best fast food burger, often tied with In-N-Out. And I guess you could, I don't know if any, I don't think everybody would agree with that, but I could see it being at least top three, top five in something like that. I don't know. I mean, I don't eat like restaurants at like Burger King, McDonald's, Wendy's, stuff like that. So I don't know. Most fast food I don't eat. The only ones I'll have once in a while is like Culver's, and I've had In-N-Out maybe once or twice before. Shake Shack I've had at least a dozen times probably. So Shake Shack I'm much more familiar with. But Culver's is up there. You got Five Guys. You got there's so many burger players that it's going to be hard to rank up there. This is a good point too. While experts love them, general consumers rank them behind In-N-Out and Culver's in terms of value for money. At $12 to $15 for a meal, they are viewed as a premium choice. And that's true, but when you go to most Shake Shacks are busy. I literally have in the last year, I have been to locations in Nashville, Chicago, South Florida. Like anywhere I go, there is definitely a demand and a strong customer base for these locations. Like where was I think yeah, I was in Florida a couple months ago, and the location by me in South Florida, like it was a big location, and there was lines there, like lines out the door, like and huge waiting times. So I don't think they're struggling with that. And if they're charging whatever, 13, $14, $15 for a meal, you would think the margins would be better, right? But they're not. And so I think that they're just investing heavily in growth and stuff. Maybe that's what it is. Right now they're dealing with inflation with the beef and all this stuff. But it is weird because if they're charging more and they have a strong customer base and they're expanding number of stores, why isn't it you know what I mean? Why aren't the numbers way better? So that part's a little bit confusing, but it is what it is. Like I said, I think they have a solid business model and good food and a strong customer base. It's just the valuation does not make any sense. This company is not growing at 50% per year. So why are they valuing it at over 100 times earnings? Why aren't you paying like 40 times earnings or 30? That's the way I would see it. So that's my analysis for Shake Shack. Let me know what you guys think down below, and I will see you in the next video.